welcome to the deep dive. There's just so much information out there today. It's easy to feel swamped, right? Especially with complex stuff like figuring out a company's financial health. But that's why we're here. We want to give you that shortcut, that deeper understanding. Today, we're taking a deep dive into profitability ratios. Now, these aren't just, boring numbers on a page. Think of them more like the vital signs for a company. They tell you how good a business actually is at turning what it does every day into real profit. So, our mission here is to pull out the really key insights from the sources we've looked at. We want to help you get what these ratios mean, why they matter so much, and how to actually read them in the real world. Before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, the explanations we're discussing, it all comes from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely visit the website. They've got extra practice questions, video lectures, and lots of detailed support to help reinforce what we talk about today. A special thanks to Professor Farhat for providing this great material. All right, let's unpack this then. We hear the word profitable all the time. But, what are profitability ratios really measuring?
Well, fundamentally, they're looking at how much profit a company makes relative to other things like its sales revenue, the assets it owns, or the money invested by its owners, its equity. We talk a lot about, liquidity, can they pay their bills, or solvency, can they survive long term? But profitability ratios, they're kind of the bottom line, aren't they? They tell you if the whole business idea is actually generating value. And honestly, the best way to get these is to look at the actual numbers and figure out what they mean. Put yourself in the shoes of, say, an investor or maybe an auditor.
Right, interpreting them.
Yeah.
And the main tools we're using here are those core financial statements, the income statement, and the balance sheet.
Exactly. Those are the foundations.
Okay, so if we want to gauge how much earning power a company has, where's the best place to start? Which ratio?
I'd say the profit margin is the most fundamental one, often called net profit margin. It's pretty straightforward. Net income divided by sales. So the bottom line of the income statement divided by the top line. For the company example in our sources, it was 16.77% in the first year, and then it actually went up slightly to 17.73% in the second year.
So roughly 17 cents of profit for every dollar of sales they made. That seems pretty decent.
It does, yeah. And generally, a higher profit margin is better. It means the company keeps more profit after all its costs and taxes are paid. Simple as that. But, and this is really important, context is everything. You can't just look at that 17% in isolation.
What do you mean?
Well, imagine the government changed the corporate tax rate. Let's say it jumped from 21% up to 35%.
Okay.
That external change alone could knock that 17% profit margin down to maybe 14% or 14.5%, even if the company's operations didn't change at all.
I see. So factors outside the company's direct control.
Exactly. Or think about different industries. A big retailer like Walmart or Amazon, they usually have really thin profit margins, maybe just 2 or 3 cents on the dollar.
Right, because they sell common stuff, lots of competition.
Precisely. They compete on volume. But then look at, say, Apple or a luxury goods company like Nike maybe. Their profit margins are much higher, could be 20%, 30%, even more.
Because they have unique products, strong brands.
Right. They compete on differentiation and pricing power. So for someone like an auditor, if they see a discount store suddenly reporting a 20% profit margin, that's a huge red flag.
Yeah, that would see them off.
It would trigger immediate questions. You'd start digging into, okay, how are they recognizing revenue? Are the costs stated correctly? Profit margin is a kind of macro view, that first overall picture.
Okay, that makes a lot of sense. So moving beyond just sales, let's talk about return on assets, ROA. What exactly does return mean here, and what insight does ROA give us?
Good question. Return in these kinds of ratios almost always refers back to net income.
Okay, net income again.
Yep. So ROA is net income divided by average total assets. And the key word there is average.
Why average?
Because net income on the income statement covers a whole period, usually a year, but the assets on the balance sheet, that's just a snapshot at one specific point in time, the end of the period. So we average the assets from the beginning and end of the year to get a better comparison to the income earned over that year. Makes it more apples to apples.
Gotcha. That makes sense.
So imagine a company earns $10 million in net income, and its average total assets for the year were $100 million. That's a 10% ROA.
And what does that 10% tell me?
It tells you that for every single dollar tied up in assets, buildings, equipment, cash, inventory, everything the company managed to generate 10 cents in profit. It's a really core measure of how efficiently management is using the company's resources, its asset base, to actually make money.
So higher's better here too.
Generally, yes. A higher ROA suggests better management efficiency. And if you want to improve it, well, you've got two main levers.
For sure.
Either generate more net income from the same assets, maybe through better sales or cost control, or become more efficient, get rid of assets that aren't pulling their weight, become more mean and lean, you could say. Use fewer assets to generate the same or more profit.
Okay. Being smarter with what you have.
Exactly. And again, from an auditor's perspective, they'll have an expectation for what a reasonable ROA looks like for that company in that industry. If it's way off, high or low, they'll start asking why and looking for evidence.
Right. So ROA gives this big picture of asset use.
Yeah.
But you mentioned earlier, sometimes these single numbers can hide things.
Mhm.
Is there a way to break ROA down further?
Absolutely. And that brings us to a really powerful tool called the DuPont analysis, or DuPont formula. It's where things get really interesting strategically.
DuPont, like the company.
Yeah, it was developed by them way back. What it does is break ROA down into two distinct parts. It says return on asset equals profit margin multiplied by asset turnover.
Okay, we know profit margin already. What's asset turnover?
Asset turnover is sales divided by average total assets. So it measures how efficiently the company is using its assets to generate sales revenue. How many dollars of sales do you get for each dollar of assets?
I see. Sales generated from assets.
Right. And here's the real aha moment, the key strategic insight from DuPont. Most companies find it very hard to be great at both a high profit margin and a high asset turnover at the same time.
Really? Why is that?
Think about market dynamics. If you want really high asset turnover, meaning you're selling tons of stuff quickly, you often need to lower your prices to drive that volume, right? Which hurts your profit margin.
Yeah, like the Walmart example. Low margin, high turnover.
Exactly. Conversely, if you want high profit margins, like a luxury brand, you usually achieve that through exclusivity, premium pricing. That means you probably won't sell items as quickly, your asset turnover will be lower.
Tiffany's versus the supermarket.
Perfect example. They compete differently. So DuPont helps you see how a company is achieving its ROA. Is it through strong pricing power and margins, or through operational efficiency and high volume? It reveals their competitive advantage.
That's fascinating. It's not just if they're efficient, but how.
Precisely. So for analysts or auditors looking at the company in our sources with that 13.46% ROA, breaking it down tells you so much more. You can see year over year, did the ROA change because their margins improved? Or did their asset turnover get better or worse? It gives you concrete areas to investigate. Much more insightful than just the single ROA number.
That really does add another layer. Okay, so we've looked at profitability relative to sales and assets. What about the owners, the shareholders? Is there a ratio for them?
Yes, absolutely. That's return on equity, or ROE.
Return on equity.
And the formula follows the pattern. It's net income divided by average total equity.
So profit relative to the owner's stake in the company.
Exactly. It directly answers the question. For every dollar the shareholders have invested in this company, how much profit did the company generate for them?
And for the company and the source material.
Their ROE was 28.57%, which is generally considered pretty good. Quite strong, actually, in most industries.
28.57% return for the owners.
Yeah, that sounds solid.
It does. It suggests shareholders are getting a good return on their investment. But there's always a but, isn't there?
Usually. What's the nuance here?
With ROE, you have to consider financial leverage, basically, how much debt the company is using. A company can boost its ROE by using more debt financing relative to equity.
So higher debt can mean higher ROE.
It can amplify the returns to equity holders, yes, but it also increases risk. So if you see an incredibly high ROE, maybe suspiciously high, it might not just be great performance. It could be a sign the company is taking on a lot of debt, a lot of risk.
Right. More reward potentially, but more risk too. Exactly. Lenders and auditors would definitely look closely at an unusually high ROE and ask questions about the company's debt levels and whether that return is sustainable.
That's a really important point, not just the number, but how it got there. Okay, so we've covered profit margin, ROA, ROE, and the DuPont breakdown. Are there any other sort of key profitability lenses we should touch on?
Yeah, a couple more are definitely worth mentioning quickly. One is return on sales, sometimes called operating margin.
Return on sales. How is that different from the net profit margin we started with?
The key difference is the numerator. Instead of net income, return on sales typically uses income before interest and taxes, what we often call EBIT, or operating income,
EBIT over sales. Why use EBIT?
because it strips out the effect of how the company has financed the interest expense on its debt and its tax situation. It gives you a cleaner look at the profitability of the company's core operations before financing and taxes muddy the waters.
Operational efficiency, pure and simple.
Pretty much. For our example company, their return on sales was around 25%, so about 25 cents of operating profit for every dollar of sales before interest and tax were taken out. You can see how that compares to the 17% net profit margin after those items.
I see the difference. Okay, what else?
The other really fundamental one is gross profit margin.
Gross profit. That's sales minus the cost of goods sold. Love.
Exactly. So gross profit margin is that gross profit figure divided by sales. It tells you for every dollar of sales, how much is left over immediately after paying for the direct costs of producing the goods or services sold.
So before any operating expenses like marketing, admin, R&D.
Right. Just the cost of the actual stuff they sold. For the company we're looking at, their gross profit margin was hovering around 44% to 45% in both years.
Meaning about 55 or 56 cents of every sales dollar went straight to covering the cost of goods sold.
Precisely. And this gross profit margin is super important, especially for auditors.
Why is that?
Because it's very closely tied to things like inventory valuation and the company's basic pricing strategy. For most stable businesses, gross profit margin shouldn't fluctuate wildly year to year.
It should be pretty predictable.
Generally, yes. So if an auditor sees a big, unexpected jump or drop in gross profit margin, it's a major signal to investigate. Could it be errors in counting inventory, issues with how costs are being recorded, maybe problems with their pricing, or even, in some cases, fictitious sales?
Wow. Okay, so it's a sensitive indicator.
Very sensitive. And of course, that gross profit is what's left to cover all the other operating expenses, selling, general administrative costs before you eventually get down to operating income, EBIT, and then finally net income. It shows that whole waterfall effect of profitability.
It's really clear when you lay it out like that. These profitability ratios, they're not just numbers, they're like different diagnostic tools, aren't they? Each one gives you a slightly different angle, a different lens to see how a company is doing financially, from basic sales efficiency to asset use, all the way to what the owners are getting back.
That's a great way to put it. They are diagnostic tools. And the real skill, as we've kind of kept coming back to, isn't just calculating them, it's the interpretation. Understanding them in the industry context, what's happening with external factors like taxes or the economy, and crucially, looking at the trends over several years, not just one snapshot, and breaking them down, like with DuPont. That's where you find the really valuable insights, the story behind the numbers.
Absolutely. It really changes how you look at a company's performance. So maybe something for you listening to think about: how might understanding these different shades of profitability, gross margin, operating margin, net margin, ROA, how would that change the way you look at the financial news you read, or how you evaluate a potential investment, or even just how you think about the health of that local coffee shop or store you go to all the time?